This episode is brought to you by Polestar. There's only one true way to experience the all-electric luxury SUV Polestar 3, and that's to take a test drive. It can go from 0 to 60 in as little as 4.8 seconds with the dynamic handling of a sports car. But to truly understand how it commands the road, you need to be behind the wheel. Up to 350 miles of range, the 3D surround sound system by Bowers & Wilkins. It's all something you have to experience to believe. So book your test drive for Polestar 3 today at polestar.com.
Reality radio for a really great future. We're talking real money.
Hey, everybody. Welcome to, a unique edition of Talking Real Money, the podcast. I'm Don McDonald. And today, I actually have a guest. And I don't have guests very often because mainly it's me and Tom talking to you about whatever comes to mind. But today we have a guest, and it's a really, really important guest because he's going to help us understand a very important piece of information that we have used a lot over the years from Vanguard. It is a really powerful paper that came out about a decade or so ago, referred to as Vanguard's Advisor Alpha paper. And joining me is Michael DeJoseph, who's with the Vanguard Investment, I forgot what it was called again, Investment Research, Advisor Research. I thought I had it, but then I forgot it.
That's like a word jumble. We'll just, investment, advisor, research center.
Investment Advisor Research Center.
There we go.
I guess they research investment advisors and what investment advisors do for you. But before we talk about the paper, Mike, let's talk a little bit about the basic concept, just to start everybody off with the baby step.
Yeah,
What's alpha?
Yeah, sure. You got it. And thanks for having me. I'll try not to do my best Tom impersonation here.
Oh, please don't even bother to do a Tom impersonation. No.
Plenty of
nobody can do Tom, and thank God for that.
So Advisors Alpha is a concept that actually was developed. It's 25 years now, right? So we've been talking a lot here at Vanguard about our 50-year anniversary of our firm. Is it
25 years since this paper came out?
So it's been 25 years since the term was actually coined internally.
Wow.
So now half of our company's history. Really interesting story. So my boss, the individual, Fran Canary, who runs the Investment Advisory Research Center that I'm a part of, coined the term back in 2001. And it was something we kind of used internally. Started publishing on it in 2010. So we're looking at 15 plus years of putting it out in the public, and that 2010 is around the point in time when Vanguard really started partnering with folks like yourself and firms like yours out in the industry. But concept in a nutshell was, at the time when it was coined, it was, hey, we're looking around at advice, and the vast majority of what people would consider then, and some still consider today, to be financial advice is really being sold a product, right? And so Advisors Alpha was basically saying, hey, advice, really good quality, high quality financial advice is so much more than just buying an investment product. And so it was expanding the value proposition of what advisors do to include all of these other things. But yes, including the investment portfolio, right, lowering costs, the tax management, the financial planning, the behavioral coaching element that comes in there, right, like all of these different goals-based financial planning and wealth management strategies. The way I like to describe it, right, you asked what's alpha?
Yeah, what's alpha? For people going, okay, advisor alpha, but I don't care about that. I don't know what an alpha is.
It's an Alfa Romeo. It's an Italian car.
It's a nice Italian car.
Alpha, with a P, not an F, right, is this concept of how well did you do or not do versus a benchmark in the investment world. And so a simple answer, right, let's take the S&P 500, which is the 500 biggest companies in the United States, common benchmark. So if you're a professional investor or fund manager, you'll basically say, my goal is to do better than this, bucket of the 500 biggest companies in the United States. And if you do, that's considered alpha, right? So if the S&P 500 returns...
That's positive alpha,
very difficult, increasingly rare, certainly persistently, but S&P 500 gets 10% in a given year. Let's say you do 13, you got 3%. That's your investment alpha.
Now, that is something that mutual funds often brag about, their return over their benchmark, actively managed funds. Of course, index funds don't have anything to brag about. They're just index funds.
Right.
But as you said, it's increasingly rare. Spiva does their semi-annual report on index versus active, and they find very consistently, and particularly over longer periods of time, that active management adds nothing. In fact, it subtracts most of the time. So how is that different for advisors? It appears that adding alpha for anybody is hard.
That's right. And, some can do it, right? I think all of our research that we've done for decades has shown the biggest driver of that is just the cost hurdle, right? There are so many talented people in this industry trying to add that alpha, and it's just really hard to do if you have high costs. But to answer the question, what does that mean for advisors? Well, let's start with, so in the investment industry, alpha is a zero-sum game, right? And then you subtract costs out of it, and on average, like in aggregate, the whole entire market's going to underperform, because if someone's outperforming, someone has to underperform, right? You buy a stock, someone has to sell it to you. You sell one.
So it is a zero-sum game in the short run, because the plus comes from the long-term aspects of economic growth, corporate growth, interest rates, that kind of thing.
That's right. But in terms of like active versus passive and the benchmark, I mean, it's a zero-sum game mathematically over time, right? So advisors alpha, we think, is a positive sum game, because there are things that advisors do, good advisors, right? I know you guys had a recent episode about, is advice good, right? Like the average advice isn't necessarily good. Good advice is not something that if you do it well, it's taking away from someone else. Like you doing a good job of tax planning or retirement planning, or you doing a really good job of being there for your clients when it's really hard, when the markets are volatile. Your clients are winning because they're staying the course. Your clients are winning because they have tax-efficient portfolios, or they have tax-efficient drawdown strategies, or they have low costs. By you doing that, it's not adding cost, right? It's not adding bad behavior to someone else, because you're able to drive good behavior for your clients. So it's a positive sum game. And so to kind of like tie that up, right? If you think investment alpha is, did you do better or not than an investment benchmark? Well, advisors alpha, and this is kind of the crux of our research and where I've spent a large portion of my career at this point, is figuring out compared to what. Like we don't have an S&P 500 that says, hey, without Don as my advisor, where would I have been? But that's the reality. Advisors alpha is, where are your clients today across all of these different dimensions, some of which are financial, some of which are goals, some of which are emotional. Right? Like
let's start at the very beginning, because I want to give away the ending. And the ending of this paper was the number, and I didn't remember how long ago it was, but I do remember reading about this paper in some publication somewhere. And I went to the other folks in my company and I said, Vanguard is saying that we can add 3% per year to investors' returns by being good managers. I read them that number, and they told me I was nuts.
And then they told you to raise your fee.
Yeah, exactly. No, but we're at 3%. That seems like an incredible. That would basically say, if I am a regular investor and I'm investing and making, I'm buying stocks and bonds and I'm making an average of 7% per year, that if I have a good advisor, even though I'm paying them money, I can make 3% more.
Oh, man, I get to be Tom now and argue with you.
Okay.
Right? So we'll have it a little spicy. I would say that's not what it means.
But no, to me, that's what it originally sounds like. It sounds like I'm an investor. If I get an advisor, I'm going to go from 7% per year to 10.
Yeah, and I think you know our firm well enough to know we'd never say that, right? So what we're actually saying with that 3%, and happy to dive in the details, is you're getting 7%. Like you're working really hard to earn that 7%, right? You're doing your investment due diligence, you're building your portfolios, you're getting your clients to stay the course, rebalancing, all of those things. We're not saying, if you're getting 7, listen to Vanguard and you'll get 10. What we're saying is that if you're getting 7, your clients are probably taking home well less than that.
So we're talking about, the bottom line is investor returns.
Well, we're talking about gross returns versus net returns.
Net returns. Yeah, Morningstar, I believe, calls them investor returns.
Yep. And so that's that. Well, the investor returns are one element of it when we talk about behavior. But again, there's the taxes and things here, right? Like,
oh, yeah. Okay.
So I would think of it this way. Think of, let's just round up, right? 10%, easy number. Let's say, high equity investor. The average investor in aggregate is probably lagging that by about 200 basis points in investor returns across the industry. Some years it's much higher, some sub-asset classes it's much higher, and some years it's lower, right?
And that's in large part because of our behavior, because we buy and we sell. We get excited and we're buying when the market has already risen, and then we're selling after the market has already fallen.
Yeah, and firing and hiring active managers, before or after periods of outperformance. All these different behaviors. That's I love that. I could talk about that all day. That's where I spend most of my time on the behavioral side here. But that's only one source of leakage, right? Then there's also costs and taxes. So again, the average dollar weighted expense ratio of our industry is closer to 60 or 70 basis points still versus what you could be getting in a lower cost ETF, right? And so it's call it 40 or 50 basis points there potentially. It's significantly lower now. I think that's an incredible news story for investors that costs have come down across the board. And then again, that taxes is a big one. And we look at that both in terms of accumulation and decumulation. It's like, what types of asset classes are you using? How are you filling those buckets of the different accounts, right? Like, using municipal funds versus taxable bond funds? Are you putting them in a 401k or an IRA versus a taxable registration? Those are really impactful decisions. And then the same thing in the spend down phase of investing as well. It's where are you taking the money from? Do you start with the IRA? Do you start with the taxable account? What about Roth? Right. And when we quantify that, each of those is probably worth about 100 basis points a year as well. And so you start to add these up, and that's not even, again, we're not even talking about investing, right? Building the portfolio, which we know is incredibly value add. So we came up with that 3% number that's kind of gone viral over the years, but that didn't even include, the asset allocation that you set for your clients. That didn't include, if you are using active management, are you able to find those good managers persistently that outperform?
Let me stop you on that point. That's somewhere I wanted to go, is finding active managers who outperform. This is a real sore spot, particularly with me, is this whole concept. And matter of fact, this is an argument I've had. We actually had this argument with a guy named Jack Bogle a long time ago. That tells you how old we are. And the argument is, wait, all of the evidence, all of it, basically says that it is a fool's game to actively manage mutual funds, to actively manage investment portfolios, to pick markets or to timing or to pick stocks. And the fact of the matter is Vanguard is well known as an index house, but Vanguard is also an active house. With all of this data showing that active doesn't really work, and then the other data, particularly from Swiss Finance Institute and the Fama and French study that shows that most active outperformance is more likely attributable to luck than skill, doesn't that lead you to think that maybe even bothering with active is foolish?
Yeah. It's interesting. I was fortunate enough to have lunch with Jack Bogle at one point, and he was, been just a huge figure around here, and he was, on campus every day until he, unfortunately passed a few years ago. His legacy echoes through the halls here, and it's interesting because we're celebrating our 50-year anniversary here at Vanguard this year, and we're just spending a lot of time reflecting on the history of the company. Vanguard was founded as an active shop. Jack Bogle spent the vast majority of his life as an active manager. Yeah. And so he's, it's for him, it's the cost matters hypothesis, right? We argue about the efficient markets hypothesis, EMH. He says it's CMH. That's one. Two, the evidence is indisputable.
CMH, define, just for everybody listening.
I'm sorry?
CMH, define that.
Cost matters hypothesis. So
yeah,
it kind of goes back to...
I want to make sure we cover that so listeners aren't going, what the heck is CMH?
Yeah, what's a CMH?
Cost matters hypothesis. That's saying that one of the biggest drivers, and we believe that, of success is paying less.
Yeah. Hey, like again, and you know this, there are so many smart people in this industry, and most of them are well intentioned, but
No, you're
there are a
not
lot of
kidding. I
people
am.
chasing outperformance out there, and all the different stats and numbers you've cited. It's extremely difficult, especially in the liquid public markets, to consistently outperform the market. I would say, especially on the equity side. Fixed income, like when we look at our side of that house on fixed income, I think there's a lot that goes into there's just so many more bonds than there are stocks, right? Every company, every government's issuing so many different series, and there's a lot of work that goes in there around security selection, around just looking at the contracts that underlie some of these bonds. So I think there's probably a little more persistence there. It's also
So there may be more inefficiencies, in other words, potentially exploitable inefficiencies in the bond market than there are in the stock market. Is it possible, just kind of as a little observation on the side, is it possible that during Jack's formative years and the earlier days of mutual funds, is it possible that there were actually more exploitable inefficiencies in that day and age because data moved much more slowly? There wasn't the prevalence of information that we have today. Is it possible that that's why active managing persists, but indexing is starting to win?
Yeah, I think that's possible from the sense of like the technical element of the market. Like maybe you could get, if you had information faster legally and you were able to trade on it, you had an advantage over the retail investor. But ultimately, I think, active management on the equity side really does come down to predicting the future, and just not something that's possible.
Let's go back to the definition of a good advisor.
Yep.
Because this is an area where you're going to get a lot of pushback because every advisor believes they're the good advisor. They all do. As a matter of fact, if you listen to a couple of shows, you know that lots of advisors claim they're fiduciaries when in fact they're selling high commission products. I don't think you can be a fiduciary and sell a high commission product. I just don't think that's a possibility. So what is your definition of a good advisor?
I'll one up you. I'll say I have a definition of a great advisor.
Okay, it's even better.
Right. I think a good advisor is an advisor who's doing all the things that we talked about. They're building portfolios, whether they're, again, Vanguard's not a anti-active shop. We're a huge active manager. We believe it works. So I'm going to kind of like move away from that. I think if you're building good long-term portfolios with high conviction strategies and importantly sticking with them, that kind of takes care of most of the investment side of the house. Whether it's active or passive, I think is kind of secondary to that much more important decision of what's the strategic asset allocation, right? Meaning what's the stocks versus bonds versus cash, rather than like what percentage of it's active or passive. Research would say that's like 90% of the battle right there. So there's that, right? I think a good advisor is doing a good job of that. They're probably doing some retirement planning. They're doing, they're producing a financial plan at the very least. That's a good advisor. A great advisor is an advisor who understands that an investment portfolio and a financial plan are both a means to an end. And that end is helping clients achieve what it is that's important to them. And I call it their values. And so the way I would think about that is, most investors are going to say retirement is probably their primary goal, right? A really good advisor is going to put together a really, really good retirement plan. All right, they're gonna have a great relationship with their clients so that when things are hard, right, when the markets, I had a colleague of mine who sits near me who was retiring in July, and we had to talk him off the ledge in March, right, in April when the market was down 20+% pretty quickly. Doing that,
we did a lot of ledge talking off of, yes.
That's a lot of the job of the advisor. It's also the biggest number in our advisor's alpha study. But the great advisor is going to be the one that says, okay, great, like retirement, that's wonderful. But what does retirement mean to you? Like, what is your value? Is it spending time with your family? Is retirement, hey, you want to buy a beach house? Okay, like that doesn't sound particularly noble necessarily. But when you start digging and the client says, well, I would like to buy a beach house because my family's scattered around the country. And if I have this cool place that we can all gather for 2 weeks a year, it's going to be the best memories of my life and hopefully memories that will stick with my family for the rest of their lives. And the great advisor is going to have those conversations and they're going to say, great, I will help you achieve that. Don't worry about the details. I'm not going to bog you down in this argument about, efficient markets versus cost markets and right? Like active, passive, and I'm not even going to bog you down with the math that goes into, what percentage chance you have of replacing your paycheck and all those things. They're going to say, hey, you go home, focus on what's important to you, right? Focus on, your career, your family, all of those things, and trust me, right? I have well-earned trust because we've been through this before, and I will help you achieve those values. Those are the very, very best advisors that I've had the privilege to work with. It's increasingly frequent that that's the model. I will say, literally my favorite advisor I've ever worked with in the entire industry is at your firm.
Really?
Kathy Parks. I'm not sure if you know Kathy. So Kathy's in the Knoxville office. Someone who's become a friend of mine who I've worked with over the years, and that's...
Well, and I love Knoxville. I'll go visit Knoxville
right?
anytime. It's not far. I'm in Florida, so I'd get... In fact, right now, I would love to go to Knoxville. I'm sure it's cooler than here.
So I didn't tell Kathy I was going to tell you that, but
that's really nice.
She's someone, again, that's just so thoughtful, the way she talks to her clients and builds relationships with them, and is really transparent about her life experiences and what's important to her, and kind of creates that shared experience with them. And not only are those the greatest advisors I've worked with in terms of what they're able to do for their clients, again, not just financially, not just reaching the goals, but emotionally, and creating the peace of mind, creating those positive emotions that are so rare when it comes to investing in taxes. But they're also the happiest advisors. That's really meaningful work.
I mean, it's an overused term. It's used everywhere, but what you're describing seems to be the holistic versus the merely financial.
That's right.
So it's looking at the whole client's life situation, needs, wants, desires, fears, everything. That's what makes a great advisor. And
the reality is most individuals, just in the conversations that I've had with this archetypal advisor that I'm explaining to you right now, most of those clients have never actually even had those thoughts before, because it's, there's this thing, it's hard to have new ideas and to articulate completely new things without being prompted. And so, really, really great advisors are asking really great questions, and they get their clients thinking and articulating things they didn't even know they knew.
Wow. So I guess what that leads me to is this whole concept of picking the good advisors. There was a piece done, I don't know, 10 or 15 years ago. Again, I'm getting old. I lose track of time. By Market Watch, where they looked at the numbers, looked at all of the advisors, all of those registered to sell financial or give financial advice in America, and they came up with a number of about 1 million. And they calculated that of that, about 1% were always required, always being the key word, required at the time to act in the client's best interests. Why are really, truly 100% fiduciary advisors so hard to find, and how do you do it?
That is a very good question. I think some of it, right, and we're talking about the legal distinction of a fiduciary versus not. Look, there are really, really great advisors who absolutely do amazing high trust work for their clients who maybe aren't under that structure. So I'll start with that caveat, and I get to work with them, so I see it, so I know that.
I know you have to say that. I, on the other hand, could say anything I darn well please about.
Yeah, I'll be the first.
I'm sure
there's a lot who are not, and some of it is just. Maybe we pull the hood back on the industry a little bit for your listeners. Like, there's a couple different ways that financial advisors can get paid, and we've kind of hinted at it, right? There's the commissions and transactions, and then there's the fee-based, where you charge a percentage of your AUM. When I started doing the Advisors Alpha, 80% of the revenue in our industry was coming from transactions and commissions, and today that's only about 10%. And that happened really quick. That happened after the financial crisis of 2008, 2009. And I think back.
I just actually had a shocked expression on my face for those who can't see me, which is everybody except you. It's gone from 80 to 10?
Yep. Yeah, and it all happened. It almost entirely happened in the period of time from 2010 to 2013. And I think a lot, right? My hypothesis here, I think we as an industry, meaning financial advice, and that doesn't count a firm like yours who's always done fiduciary, right? And like the whole registered investment advisor, independent advisor space has always been fiduciaries. But you look back at the headlines during the financial crisis. I remember the individual who ran the advice business at one of the big, prestigious names on Wall Street. One of the stories came out. He had $1 million gold toilet, right? And the average client lost 50% of their worth. People were losing their homes, losing their jobs. It was just an extremely tragic period of time. And I think it just completely and utterly destroyed the trust that clients had in our industry of financial advice. There was some threat of regulation with the Department of Labor rule that was kind of bandied about.
Right, the DOL fiduciary rule.
Yeah, the DOL fiduciary rule, I think, forced the hands. Like it never actually took effect in the way that many thought that it would, but I think it forced a lot of hands to just start doing business a little better. And then take all that out to the, put that all that aside. I think the single biggest driver is investors just got smart. Like, you had the internet now, and you can go out and look at reviews, and it's like, the other thing here too, and I want to go back to one of your prior episodes where you talked about where people were getting advice. The number one place that people were getting financial advice was from friends and family. Well, guess what? We've done research on how do people pick financial advisors. The number one reason that people pick a financial advisor is a referral from a friend or family. And so I think the advisors who were doing really good work through that period of time, I think word spread, right? Mm-hmm. And people got smart on this. And so the business model changed quickly. Word spread. The choice was out there. And I think investors voted with their feet and forced the hand of the entire industry. And I think that's probably the biggest driver of how we ended up where we are today, which is that most advice is really good.
I've noticed recently, because I follow the advice industry and look at the big firms, the little firms, the independents, the wirehouses, and there has been a huge shift, particularly among the wirehouses, the big brokerage firms, the Morgan Stanleys and the Ameriprises and the LPLs and all, toward a fee structure. But their fees, it's a fee-based structure, not fee only. There's still some commission sales going on. And here's the big question. Some of these people charge 2 and as much as 3% per year. What does a charge like that, a 2.5% or a 3% on the first $1 million, do to Vanguard's advisor alpha?
Yeah, so I look at it this way. We look at fees every year. We publish a study every couple of years on what the average fee is, and we look at it by different net worth, by different household sizes. The dollar-weighted average advice fee for our entire industry is 99 basis points, according to our most recent.
Dollar-weighted, so that includes all the break points at $2 million, $3 million, those kinds of things.
Yeah, it's kind of it's downward sloping, right? So when you look at like mass affluent, the $100,000 market, that's the highest cost. And the lowest cost is going to be the ultra high net worth, where that next 10 million or the next 20 million, you're extremely low fee. We actually haven't seen the fee itself change a whole lot on average. Now it's come down quite a bit on the lower end of the market, and I think that's largely been driven by technology based options and really low cost like robo advice and hybrid advice. But that said, the way we look at it, and we try to be very careful in a couple ways. So again, I get to work with advisors all over the world, and they see our 3% study, and some of that inclination is to be, hey, well, you said it's worth 3 and I'm only charging 1 or 2. Like, shouldn't I raise my fee? And so, one, the advisor's alpha is meant to be more of an art than a science. It's totally a rule of thumb. We're saying over a long period of time, some of these things that we've talked about in here, or most of those things, probably apply to most investors at some point in time, and it adds that value. But what it does, and it's an interesting thing when you look at the economics of the business, if you're charging your clients too much, it's a lower revenue base for the advisor themselves. And again, word is out. People are smart. Like if you're charging your clients 3% and you're doing an incredible job for them and they're accumulating wealth, and maybe it's worth it to that individual for the relationship. But if you're charging them 2 or 3x the average fee and you're not doing just incredible work, and they start asking questions, they're going to say, hey, I can go get a better deal somewhere else, with better service. And they're absolutely going to hear about that because, again, almost all almost all of the business that happens in our world, the financial advice world, comes from personal referrals or some kind of connection.
So you've kind of laid out the good stuff that advisors provide, the things that add to that 3%, the portfolio construction, taxes, fees, behavioral guidance, that kind of thing, that they all in aggregate, those add up to about that 3% number. What, though, on the other side, as we get ready to wrap up here, what is some of the most dangerous advisor behavior that you've seen in your research?
Yeah, it's a great question. I'll say the whole Advisors Alpha framework is basically saying if you were to do this, right, or if you are doing this, which we would say is, not to be condescending, but let's say the quote unquote correct way, right? If you invest with low costs, if you do, broad diversification, if you have good investor behavior and good tax efficiency, we're basically saying, well, what are people actually doing on average? Or what could they be doing versus, what does good advice look like? And that's where that number comes from. That's kind of the framework. The reality is, though, the vast majority of the assets in our industry are advised in some way, shape, size, or form. And so that average experience that we're comparing, the better path, right, that better future to, is comparing to what a lot of advisors are doing. And so it's basically the opposite of everything we're talking about. It's doing investing that's chasing performance, or maybe doing high cost active and then not even sticking with it. This is just totally from my book, not our firm's opinion per se. It's like I look around and I see who are the biggest, wealthiest, most famous investors of all time, and what do they have in common? And my answer is effectively nothing other than they stuck with it. Right? Like what do Warren Buffett, Cliff Asness, and Bridgewater have in common with each other? And it's literally nothing other than they picked something and stuck with it for many decades.
So it's a disciplined approach. So basically the bad behavior is the opposite of that.
That's right.
Now, when you talked with advisors, when you talk with advisors, are you advising them that they need to rethink the way they do business?
Not in so many words, I would say.
I don't want to get in their face, but
I think what my team does, and again, we're the Investment Advisory Research Center, and so we research both the end investor and the advisor practice. And so we have kind of this tagline, we're like, good for your clients, good for your business. And what we like to look at is, where are those two things the same? Like what can we counsel advisors on that we know will be really good for that end investor? Because the reality is, like, Vanguard's biggest division by far and our fastest growing for more than the last decade has been through financial advisors. And so these are mutual clients of ours. Like, our company exists to take a stand for investors. If our investors are working with someone like you or your firm, like, they're our client. And so we feel like we have a duty to make sure that they're getting a good deal on advice and that they're getting good outcomes. But, for financial advisors, right, it's saying, great, like, why would I talk to Mike DeJoseph from Vanguard or someone who's representing Vanguard on the product side? And our answer is, hey, like, we think that we have found unique solutions and unique insights through our research and through our experience and through our conversations and our partnerships that will drive those great investor outcomes for your clients, also in a way that will help you get new clients, right? It'll help you get referrals. It'll help you keep the clients that you have, right? And we have this, it's almost like a flywheel effect. It's when you're growing your business and you're providing really good advice, other people want to be part of that. And if that advice is good, it's driving great outcomes for your clients. And that's what makes your clients want to refer you to other people. And again, it becomes this like really meaningful and almost profound flywheel effect of you're doing well, your clients are doing well, and everyone kind of wins. And that's not the norm, I think, in the financial industry. But I do think it's becoming more and more the norm. And I think that's the reason that we've rebuilt some of that trust that I talked about as us kind of losing after that financial crisis of 2008, 2009. So that's kind of how we go about it. Those are a lot of the conversations that I'm having with advisors, and it's generally very well received. Why wouldn't it be?
Well, since we've gone so quickly from a primarily transactional industry to an industry that is charging a fee for services very quickly, Where do we go from here? And I have to ask this, how does AI fit into changing that?
Two very good questions. The first one, I would say what happened is the compensation structure changed very quickly. That doesn't mean that the services did. And so what I mean by that is that traditional value proposition, I'm going to sell you a mutual fund or sell you a stock and charge you a commission, went very quickly to I'm going to charge you a percentage of the amount of money that I manage. That happened quickly.
But it's still going to be transaction based.
Right. That doesn't mean that overnight, all of a sudden, it's like, well, I'm going to charge you a percentage of your money, and then I'm going to do all these other things. The financial planning, a lot of it was like, I think that's kind of where we're at today. And so the AI question, I think it's related because what happened in around 2015 or so, we saw a huge influx of capital into our business in the form of what we call fintech and the proliferation of the robo-advisor. And what that led to was more choice for consumers, but also better technology for advisors like you to do all of the things that we're talking about in a way that takes less time. And so a lot of things I would say got kind of automated in a sense. And then I think the answer to the AI question is that it's going to take all of the things that the advisors are doing today that are what we call uniquely human. It's the stuff that can't be done by technology. It's exactly what we've been just talking about, like having conversations with your clients about their values, about what's important to them, asking good questions. I think the AI is going to, free up some of the advisor's time from some of the administrative stuff, right? Like taking notes and compliance and filling out forms, rebalancing portfolios, all of these things that are really time consuming that are not you talking to your clients. And then I also think, and maybe we're not quite there today, but my guess is that, 5-10 years from now, it's also going to enable you to have better conversations with your clients, right? Like just a totally made up example. Maybe the software exists. If not, it probably will soon. I'm gonna call
ChatGPT and have her write it up for me.
It probably exists. It's crazy. Every time I think it can't do something, it does it. But let's say you're having a conversation with your client, and maybe you're not picking up on an emotion that's in there that maybe technology can kind of listen in on the conversation, pick up some sort of emotional skittishness about something going on in the market, and enable you to execute a behavioral coaching opportunity there, rather than let that thing stew. That's just one example, but I think there'll be a lot more of that. And what that's going to lead to is, again, better client outcomes, right? I think investors will be better investors. They will get better advice, and they will be achieving those goals and those values. And I think it'll make the job of the financial advisor more efficient, so you can do better advice for more clients. And again, I think that's a win-win.
So it sounds like what you're saying is we're going to see a gradual shift toward something less investment advisor and something more financial therapist.
Yeah.
That sound about right?
That sounds exactly right. And again, I think that's where we're at today. Like we would say we're still probably in the relatively early innings of that, but I mean that's where the growth is.
That's better. That's where you better be if you want to be a top tier advisor.
That's right. And if you're a client, that's what you want. Like we started this whole line of conversation around like, how do you pick a good advisor? That's it. It's you go in, you meet with the advisor, and if they're asking you questions about what's important to you, I think that's a good start.
And if they ask, how much money do you want to make, or they give you an idea, run away.
Yeah. And if their value proposition is, hey, I'm going to get you X percent, I know that's compelling, right? To walk in and say, I'm going to make you rich. It's like, okay, great. But, I had a colleague, he always said the important distinction is required versus desired returns. It's like, what return do you desire? The answer is more. Yeah. It's like, what return do you require? It's like, I don't know, like what's important to you. And that's where the best advice lives.
Well, Mike, I could talk to you about this all day because it's one of my favorite topics in the world of money. But I can't. I have to end the show soon. So we don't want it to go too long. Thank you very much for helping to explain this as well as you have. And we really do appreciate all the great work you guys do at Vanguard. You guys, I've been a Vanguard aficionado for almost as long as Vanguard's been around. So thanks so much.
Yeah, I appreciate you having me on. This was really fun. hopefully I get to talk to both of you next time, because it sounds like a lot of fun.
Yeah, when we talk together, you don't get a word in edgewise.
That's fine.
This was much easier.
That makes it easier.
Yeah. Mike, thank you very much. Mike DeJoseph from Vanguard, one of those people who does all that fine research on the investment advisory business, and please keep it up. All right. We're out of time for this episode. Thank you all for being a part of it. I really, truly appreciate you being there. And of course, we're going to be here almost every day, hanging out with you, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.